Hi there, I'm Mark Sebastian. I'm the founder of OptionPit.com, and this is weekly and daily option trading, primarily weeklies. I want to remind everybody that this is for educational purposes. It doesn't constitute advice. It's for information. We're not responsible for anything. You lose money, it's your own fault. And if you have questions, you should reach out to somebody that is a investment advisor about anything specific. We're just here to talk about educating you. For those of you who don't know me, my name is Mark Sebastian. I was a floor trader for about 10 years. I'm the one on the left. I'm not the redhead. I traded options on the Amex, the American Stock Exchange, and the CBOE. And after I left the floor, I started Option Pit. What is Option Pit? Well, what we do is we teach retail traders how professionals trade and think. Our goal being to teach retailers such as yourself to be pros. In addition, I run a couple of small hedge funds that are private. I really enjoy what I do. So today, what you're going to learn, we're going to discuss Decay, talk about what weekly and daily options are, why it's important to trade these contracts, ways to take advantage of weekly and daily options, and the use of weekly and dailies in a high volatility environment. And then I'll look at a trade at the end. All right, so let's talk about Decay. Over the life of an option contract, the contract is decaying. Near-dated options decay the fastest if they're at the money, closer to expiration. Right? They have an exponential decay. Further out of the money, of options have a more linear decay. We understand the difference between exponential and linear. Exponential means the decay is growing, and linear means that the decay is flat. At the money options have a exponential decay. Out of the money options have a generally linear decay. So let's look. This is the way many of you are probably taught, right? Oh, you sell an option at 30 days and the decay is exponential, so you're making all kinds of money, right? It is super easy to sell options because the decay from day 30 to day 0 is so big, right? There's this crazy amount of decay the final 30 days. The issue is a lot of people are taught that is the way all options work. How many of you have been told that all options decay like this chart? How many of you have heard that decay is different depending on the option? Yeah, right. You've all been taught that, oh, decay is exponential. Here's the thing, it's not if you go further away. It's not. Decay, as you move further away from at the money, becomes linear. This is the way an out of the money option decays. What do you notice? What do you notice about this decay chart? Right? Believe it or not, an option that is 10% out of the money actually loses more dollars from day 60 to day 30 than it does from day 30 to day 0. Let me repeat that. An out of the money option that is 10% out of the money. So in SPY, we're talking 25 bucks either way. That option that's $25 out of the money loses more value from day 60 to day 30 than it does from day 30 to day 0. How many of you are surprised to be told that? Yeah, I'm seeing a lot of people that are not students of Option Pit saying, yeah, they thought that they did not know that decay was different depending on whether an option was in the money, at the money, or out of the money. We had one person say, yeah, but I've taken your classes, so that's how I know. Well, good. That's great, because that is going to change the way you think about trading going forward. If you understand that at the money options is where all that exponential decay is, and out of the money options are where it's more linear, would that changes the way that we develop spreads and develop trades. All right. So the key to the equation with understanding option decay is that unless an option is at the money, the old exponential decay most retailers are taught just doesn't happen. And here's another thing to think about. An option that's less than 5 cents hardly decays at all. Hardly decays at all. All right, an option that's 4 cents that has a theoretical theta of 3 cents will typically, so it's decaying 3 cents a day, will typically only lose about a penny. Why is that? Well, there's two reasons. One, market makers get charged something called minimum haircut. Minimum haircut means that even if the option is worthless, we have to pay our clearing firm to hold them. So we don't like being short worthless options. And two, while there's a theoretically you make a lot of money shorting if you shorted every single nickel option, every single one, you'd make money. However, how many of us have the bank account to short every single nickel option on every single stock in the entire stock market? The answer is none. Even as a market maker, I was only trading 100 stocks. All right. Actually, I was talking to a guy I used to work with. You know how many stocks he's trading now? 800 as a market maker. So those options that are a nickel, even at 800, all it takes is one bad option, and it can wipe out all the gains for the year. A couple of days of a stock completely tanking. Think of what's a stock that has kind of surprisingly lost a ton of money in a short period of time in the last couple of months? Nah, Amazon, no, because someone said Amazon. Amazon lost a lot of money, but really as a percent, not as much. I'm talking. Anybody ever seen a biotech? Facebook's a great example from a few months back, right? When Facebook went from 220 to 150 in about a week. There were cheap options that went from a nickel to $30. You know how many nickels you need to sell to make up for a $30 loss on an option? All right, I'm going to pull out my little calculator here. 30 divided by a nickel. I need to sell 600 options to make up for that nickel. Or to make up for that $30 I lost. Think about that. Who's got the money to make 600 trades to make up for one? Nobody. That is why these cheap options that nobody wants to sell do not lose value. If there's nobody to sell an option, it will hold its value. So, what is my point? My point is that, and if you leave with just this, the webinar will have been worth it, in my opinion. Once an option is worth less than, let's say, a nickel, what do you think the best course of action is? Let's say 2 weeks ago, an option is worth a nickel. What do you think the best course of action is? Close it. Yes, thank you. Close it. Take the money. There is more efficient ways to use your capital. You're saying, Mark, I don't want to pay the commission. It's $1, the equivalent of a penny. So it's just not worth it. I'm never, ever, ever short penny options, even if they're going to expire tomorrow, even if they're spread against something else. Great. So now, any questions on Decay before I move forward? So now let's talk about weeklies. So it's now been almost 10 years since the SIBO launched weekly options. They came up with them and then everybody copied them. When they initially launched, they expired every Friday, but there was only two listed. So there'd be a weekly option that it was expiring, and then a new weekly the Thursday before it was going to expire that would be listed. The problem with this approach to weeklies was that it created crazy decay structure around them. You would see like just all this crazy amount of decay on Thursday and Friday, and they became really hard to own and trade. So what SIBO did, they realized kind of they were doing it wrong. And they started structuring so that they are listed 4 to 6 cycles out. So at any given time, in a regular, like an equity option, there are usually 5 or 6 weeklies that get listed 6 weeks out. 6 weeks out, there's not really as much decay around all those options. So they don't have this crazy structure. All right, so they now kind of decay. Now weeklies act very similar to standard contracts. Or monthlies as they're called. So here's Apple from last week. I want to show you, look how many weeklies they have. 1, 2, 3, 4, 5, 6. And then you've got the regular Nov and the regular December behind it. Now, this has come off, this expired, and now there's a December 14th contract in Apple. So there's all of these areas where you can create different duration on your trade. We're going to get to that. So now let's talk about daily options. Daily options are actually weeklies. All right. But what's going on is that in SPX and SPY, S&P 500 options can now have up to 5 expirations in a week. If things land the right way. Definitely 4. I mean, heck, there were 4 SPX options expiring. You know, if I pull up SPX here, let's look at SPY. Let's look at SPX. They're not showing the weeklies on this. All right, great. I got a setting in here wrong. Well, here, I'll show you on this then. So I want to just kind of show you how many options are expiring the week of November expiration. You're going to be like shocked. There's one on filter this down to at the money only. So there is, between now and November expiration, which is the 16th, there's 1, 2, 3, 4, 5, 6, 7. And look at this. There's actually 2 expirations on the same day. You have next week, or next 2 weeks from now, there's an expiration on the 12th, the 14th, and then 2 on the 16th. 4 options in a week. So that's why I call them daily options, is you can literally make a trade the day of or the next day or at the most with 2 days to expire. Think about that. We can trade with 2 days to expire, and that's a long duration in S&P. These dailies, like the weeklies, though, list weeks out. So there is not like this crazy disjointed decay. Now, that doesn't mean there isn't edge in weekly and dailies. There's just no like free edge. Nothing that's a layup. And there are a lot of advantages. So let's talk about what the advantages are. So take a look at, here's SPY dailies. Look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 expirations at this time. Now it's, we've had these guys go. So we still have 1 expiration tomorrow, Monday, Wednesday, Friday, Monday, Wednesday, and then normal Friday expiration. You think that gives us some flexibility? Yeah. Yeah, it does. So why weeklies and dailies? And the answer is simple. There's 2 really good answers for why you want to trade these and why you need to be paying attention to them. If you're not trading these, you are missing out. 1, duration. Duration. You can decide how long to be in a trade from start to expiration. You can set up trades that have quick decay, capturing that near dated trade. And then timing. You can avoid event risk or you can take event risk. I could buy Apple options that expired last Friday, so I didn't have non-farm anything to deal with. In SPY, I could have bought options that expired on Wednesday, so I didn't have to deal with non-farm payrolls. Am I trading? So yeah, you get to set your timing and then use that timing to avoid or take on risk. All right, so let's talk about income producing. So the key to selling dailies and weeklies is that near or at the money value. Remember, these are the options that should be sold because of that exponential decay. And then you can hedge it by purchasing the slower decaying option. So you've got, my kid is, it's amazing. My kid is in 3rd grade and they're already doing like algebraic stuff. But who remembers the old, train leaves Chicago heading for St. Louis at 60 miles an hour. And then a second train leaves at Chicago heading for St. Louis at 100 miles per hour. And 2 hours later, when will train 1 catch up with train 2? Those are what the types of trades you need to be setting up with weeklies. Let's look at a trade. So here, we'll pull up SPY. And let's take a look at the types of stuff that you can build here. Right? So SPY, overnight it's down some. I don't know if you guys saw it. So this is November 1st. Apple reported after the bell. It's getting torched. But the overall market really not eating it that much. So I think the market is going to be stable tomorrow. All right. So what do? I can sell, or let's say even the next 2 days. So what do? I can sell the 272 put. If I think it's going to go up, I might want to create some income. And I collect, look, $1.40. And I'm dealing with tomorrow and Friday. And then I can buy these options that decay slowly against it. So I've sold the 272.5. If I want to do a 5-point vertical, I'm going to get $1 out of the 272, 262, 267. So 5-point wide, and I'm getting over $1. But what's going to happen? How long do you think I have to hold this spread if I do it first thing in the morning? So non-FAR payrolls come out, we're unchanged. I can get $1 for the spread. How long do you think I'm holding it? Right? So right now, if I look at the Greeks, it's saying I'm collecting 6 cents of theta. However, I'm collecting more than that. Why? What's going to happen? I mean, let's take a look. So this is Monday's trade. Monday afternoon, so 2 days. Versus, look, 89 cents and my 267s are still 18 cents. So I lost 20 cents on my 267.5s going a day forward. Meanwhile, my 272.5s are 85 cents. Well, what's 85 minus 18? What's 85 minus 18? This is pretty 67 cents. So it says I'm creating 6 cents of theta, but really, how much decay do I have? By the end of the day tomorrow, if we come in under the exact same circumstances, this 5-point vertical that I sold on the open at $1, I'm going to be buying back for about 75 to 80 cents. And I can probably close it Friday night. At 3 o'clock after the bell rings. Doesn't sound so bad. Doesn't sound so bad, does it? Doesn't sound so bad at all, does it? So, the best use of directional trading in weekly and daily options is calendars and flies. Depending on the vol, one can set up cheapy swaps. Find a cheap vol to buy and an expensive vol to sell. Set up diagonals that take advantage of vol differentials. There's all kinds of things you can do using weeklies and dailies. So let me show you a trade that I did. This is really complex. I'm not expecting you guys to do this to get this one right away. Pull up Boeing. Really? Son of a gun. All right, let me get that open again. 1 second here, folks. Stop the recording. So I'm finding things where volatility is mispriced, and I'm trading these off of each other. So let's say I think Boeing's going up. What can I do? Well, I can buy something at the money or near the money, longer dated. I think Boeing's going up. All right, I'll buy a 3 double call. And then I want some decay. Great. I can sell a 3, it's trading 363. Look at this. I can sell a 365 call at $1.75. Nice little diagonal. I take advantage of the up move, and I get all of this decay. Boeing's up $5 tomorrow. I don't care. I'm a happy camper. Yeah, it's a nice little call diagonal. Or a put diagonal. More likely, I could do something like AMD, right? AMD's been really moving. Well, I think AMD is going to go up. So what do? I can set something up in December. I can buy a 21 call or a 22 call. Buy a 21 call. And then I can go to next week so I can buy December for $2.20 and sell next week at 76. Think about that decay ratio. What is that going to look like? That's going to produce, send this to what if. I'm going to produce crazy decay. Not bad. So what I'm trying to do is really produce cheap decay. I'm trying to produce stuff that lets me express a directional opinion, but uses this crazy volatility to my advantage. Going into today, I still have it on. I have the November, December 20 call calendar on. I hedged it with a cheapy December put spread. Not bad. So now let's talk about weeklies and dailies in this volatility environment. With the VIX as high as it is, weekly and daily options have extremely high IVs. However, because they are short dated, the relative cost of hedging or directional trading can be cheap. Heading into Apple or SBucks earnings tonight, on November 1st, I could hedge off all of my risk. So, I'll show you what I did. In VXX, I was a little worried. I have a long portfolio that I run, and I'm a little worried about volatility exploding. Let's look at VXX. All right. 2 days ago, VXX was 41. 3 days ago, it got as high as 42. Right? We have Apple on the 1st. We had ExxonMobil and Chevron Texaco on November 2nd in the morning, and non-farm payrolls. Think that's a lot to worry about? Incorrect. You think that's a lot to worry about? Well, let's go to VXX, and I'll show you what I did. About the 39 calls for 12 cents. About the 39 calls for 12 cents. If we have a crazy sell-off tomorrow, right? So think October 11th. Let's say S&P down 70. Where would VXX go tomorrow? The answer, 42. So I spent 12 cents using a weekly that expires tomorrow so that I didn't have to worry about anything. And specific to VXX, it almost never pays to sell puts. The vol, it has a weird curvature. So with all of that data, I spent $1,200, about 100 of them. If I buy 100 for 11 cents and they go out $2, how much money do I make? I make 20 grand basically. A little less than 20,000 bucks. All right, well, how much S&P does that hedge? A lot, down 70 bucks. SPY down $7, SPY down $7. Even if I'm long $1 million, if I'm long $1 million, I only lose 70,000. So for $1,200, I hedged off 30% of my risk. In the event that I'm really wrong and we're down 200, I'd lose 200,000, but VXX would be 55. I'd make 150 grand back. I'd lose next to nothing on that trade. Not bad, right? The reason why I was able to do that is because the weeklies, they allowed me to time myself in a high vol environment. It's a beautiful thing. It's a beautiful thing. Any questions? The question is, am I concerned if IV falls with the diagonal? Yes, it has Vega exposure. But one of the things I can do to limit my Vega exposure with weeklies is I can sell something that's really expensive and I can buy something that is in relative terms less expensive. So I can at least mitigate my volatility risk on a diagonal if I'm picking the right spots. You know, you have to be thoughtful when you're setting up diagonals. If you're not looking at implied volatility, you're not doing it right. You are not going to make money long term if you're not paying attention to implied volatility. All right, so dailies allowed you to only trade the gamma. So tomorrow we come in, right? And the market's moving around, and I think we're going to rally. You know what the beauty of a daily option is? I can buy a call and just bet on it running. And I don't have to worry about VIX moving around because there's no volatility in an option that expires that day. So I can trade the movement, not the vol. And then weeklies do reduce the volatile exposure from a drop in VIX or a pop in VIX. And I showed you how you can buy the cheap stuff, you can sell the expensive. Dailies and weeklies can also be used to harvest high premiums in the short term. I can use those weeklies to not be stuck in a longer term position. That's the beauty of all this. So in summary, weekly options have many advantages. And then I'm going to build a trade, guys. Weekly options have many advantages, mostly involving decay and timing. They can make great income debit spreads or credit spreads. They can make great calendar trades and diagonals and great swap trades. So now what we're going to do is walk through a trade. First, I want to give you what we're doing. All right. This Saturday from 9:30 to 1:30 Eastern, Andrew, my Director of Education and Chief Operating Officer, and I are doing a course on weekly and daily options. Call it 3.5, 4 hours. And we're going to dig in. This was just kind of a washing of what you need to know. We're going to dig in for 4 hours. The course is $297. That's how much it's going to cost in our store. We have an old weekly option in the option course available on Option Pit. It's $297. All right. Now, I'm giving you a code, 100 off, OFF, all capitals. And it's going to take $125 off of the price. Plus, I'll give you a 2-week free trial of the Vol newsletter or Option Pit Live. So you're paying $172 for something that we're going to sell at $300, and you're getting a 2-week trial. You go to optionpit.com/events to get yourself registered. Use that code. All right, so you just sign up right here. Here's that awesome Saturday class. You're going to go, yep, count me in. And then you do that awesome promo code, 100 off. 172. It's a steal. It's a steal. And if you hate the course, you take the course and you hate it, tell you what, I'll give you your money back if it's that bad. But really, what are you going to spend on? I spent more than that when I went to Costco yesterday. Not yesterday, on Tuesday. Sorry. I don't know if I should be bragging about that. I'm always proud of myself when I get at Costco. If you get out of Costco and the bill is less than $100, you are a hero. All right. So now we're going to walk through a trade. I want everybody to throw out. We're not doing any stocks that had earnings today, so the stock has to have already had its earnings. But let's look at, we will build a trade in a stock. The question is, what will we cover in the course? Butterflies, credit spreads, debit spreads, calendar spreads, iron condors. And straight directional trades. It's going to be very in-depth, trust me. So what I want everyone to do is throw out a stock that's already had earnings, and we'll build a trade around it. So we'll throw out a stock, and we'll build a trade on it. And so everybody throw in their best choice, and then I will pick one. So we're going to look at PayPal. So let's start with a vol chart. I'm going to start with a vol chart because we need to know, what is PayPal doing? What does the vol look like in PayPal? All right, what's the first thing you notice about PayPal? All right, if I just look at IV, if I just look at implied volatility, would I think implied volatility is high or low? Probably pretty high. But then if I put it in context of the realized volatility, that's that HV number, I think what? Probably pretty cheap. Cheap, 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 cheap. Right? It's cheap. All right. So now, what does that tell me? That tells me I want to be a net long gamma buyer. So now I'm going to build a trade in PayPal. And I'll do something relatively simple. All right. PayPal's moving. Where do I think it's going? Is it going to go up, down, all around? Or do I not have an opinion, right? Look at this chart. Where's PayPal going to go? It's either going to go up way through its 50, or it's going to tank back below its 200 again, right? All right, so what I'm going to do is I'm going to go out to, let's look at these implied vols. You can see, once I get to November 23, the implied vol, that IV number, stops really being very different. So I'm going to buy the November 23 trade. And I'm going to show you what I'm going to build. You're going to like this, actually. I'm going to buy the 85 calls and puts. I'm going to buy a straddle. Then, look at near-dated volatility. I'm buying 35 and I'm selling 40. So this is the type of stuff we're going to teach you guys. So that straddle's about $5. And I can sell the 80 puts expiring next week at 40, and the 90 calls at a quarter. So I'm going to collect 65 cents. So what I'm doing, you can see what I'm doing I'm going to give this a bigger range. Let's look at this on November 5th. Look at the movement here that I can get. Look at this. Not bad. I want to make the price interval every, let's say, $2. Center 85. So look at that. So initially you're saying, Mark, you can only make 40 bucks. That's if we get a move of $5 tomorrow. But what if we just get a little bit of movement up? And what's going to happen to that weekly option I sold? Where the vol's high. Right? And I can sell it again, and then I can convert it into a regular butterfly on November 23rd. That's the type of stuff. These are the type of trades we're going to teach you how to do in that class. All right. Any questions? Do we have any questions for me? You see kind of how I'm thinking? All right. I will take questions now for a couple minutes, and then I'm done. Mark, would a JOTM ratio backspread be ideal since short is exponential? Yeah, backspreads can be great in weeklies because you're getting that crazy decay and those out of the monies hold a ton of value. I actually think if that's a trade you're like kind of thinking on, but now you have to be looking for movement on that backspread. Good question. Any other questions? All right, tell you what I'm going to do. For everybody that's here, if you buy this class by tomorrow, so end of day tomorrow, I'll show you something in OptionPad. I want to show you our courses. We have a lot of courses. A lot of good stuff. I will throw in Mastering Daily Options and our Mastering Weekly Options courses that we already have on file. So I'll throw in our old courses if you buy this. Got to do it by tomorrow, though. All right. Any other questions? It's 8:30, like I promised. I want to wish everybody a good night, a good day, and I'll talk to you soon. Have a good one.